Hanna.
Thank you very much. Thank you for being here. I want to follow up on something that Chairman Brady talked about briefly. Milton Friedman once said that inflation is always and everywhere. And today we see that the United States Department of Agriculture estimates that food costs may go up as much as 3.5% this year, and that is the highest potential rate in the last, I think, 3 years. In this morning's Wall Street Journal, Alan Meltzer, a distinguished Federal Reserve historian, writes, "The Fed focuses far too much attention on distracting monthly and quarterly data, while ignoring the long-term effects of money growth. Beyond the pure inflationary concerns," he says, "some side effects of the Fed policies have ugly consequences. One of the worst is the ultra-low interest rates for retired persons to take. It forces them to take substantially greater risk than bank CDs, and that many of them relied on in the past." He says that, goes on to say, this ends usually in tears for a lot of people. And we see people that planned on a retirement and simply based on historic rates, and they're just not there for them anymore. Is maintaining a extraordinarily low interest rate for a decade, creating market distortions that will have long-term effects on the economy. And you know, it's nice to talk about being able to control inflation going forward, and that you will respond to it and keep it below 2%. But you know, last year it was 1.5%. So can the Federal Reserve identify, you think accurately, a change in economic conditions and execute an exit strategy before inflation occurs? Since, as Mr. Brady said and Mr. Melcher said, never at any time in history of this country that financed big budget deficits with large amounts of central bank money avoided inflation.
Well, I do believe that we have the tools and absolutely the will and the determination to remove monetary accommodation at an appropriate time to avoid overshooting our inflation objective. The committee, everybody on the committee, a formative experience for them was the 1970s, when we saw very high inflation and a huge effort by Chairman Volcker to tighten monetary policy to bring it down. We lived through a period in which Fed policy wasn't sufficiently tight, and high inflation led to a rise in inflation expectations. We saw that those inflation expectations could become a persistent source of high inflation, and that it could be very costly to lower inflation.
And of course,
the lessons from that period are very real for all of us, and none of us want to make that mistake again. I do believe we have the tools and the determination to avoid that. We indicate inflationary developments and inflationary expectations are part of our focus as we watch what the likely evolution of inflation is. And I can't say that, you know, that we will get it perfect, but I can tell you that the committee has adopted a 2% inflation objective in order to make clear our commitment to achieving that objective and to be held accountable for it. And we're determined to have that happen.
And of course, if we raise interest rates, our debt payments, our interest payments, will exceed our national defense budget, I think, within 7 or 8 years. I think 2021 is the estimate. So all of that working together, we really need to grow our economy to afford to be able to manage that.
We want to be able to, and we expect as the economy recovers that a point will come when it will be appropriate to raise short-term interest rates. Long-term interest rates are likely to be rising over time as that occurs, and this is something I think Congress should certainly be taking into account as you look at what fiscal burdens will be down the road.
Thank you. My time's expired.
Thank you, Representative.